Vamos a intentar tomar el pulso al mercado, vamos a hacer análisis de este, ya llevamos 6 semanas de 2026, con el foco puesto en las dudas sobre la inteligencia artificial, en el futuro presidente de la Reserva Federal y en la temporada de ganancias corporativas que, bueno, la alegría ha ido por barrios. Vamos a intentar hacer lectura desde el punto de vista de la industria de gestión de activos. Vamos a saludar a Peter van der Vele, economista y estratega en Robeco. Hi Peter, good morning.
Good morning, Jose.
Well, what is your assessment of the start of the year in the markets? Contained geopolitical risks, doubts surrounding AI, a new Fed chairman.
Yeah, we have been off to a very strong start of the year with indeed a lot of volatility, but also volatility in the positive sense. As the first green shoots of a synchronized global cyclical upswing, I think, are already appearing. In our outlook in November, we wrote about the prospect of a synchronized shift, where we expected an acceleration of growth, global growth, and a broadening out of growth. And looking at year-to-date earnings delivery, and also financial market returns, we have seen that broadening of returns. And to your point, there are also some bifurcations. Lately, the sell-off in software, whereas semiconductors and memory chip makers are still rallying. But in a sense, I think that is also part and parcel of the creative destruction on the back of this structural positive shift we are seeing in the global economy, i.e. a broadening out of growth driven by the AI revolution.
And do you think, Peter, economic risks are being contained by central banks? What do you think is Powell's biggest challenge? And it's confirmed by the Senate, Kevin Warsh.
Yeah, so I think like the ECB, the Fed is also in a fairly good place. I think that US growth likely will accelerate in the first half without immediately seeing inflationary pressures emerge. Because money growth is still well behaved. Money velocity is also low single digit. And I think that's still a benign environment to see a re-acceleration of growth without seeing immediate inflationary pressures, with inflation accelerating towards 4%. And 4% inflation for the US, that's still the sweet spot also for equity market returns. So looking back at the last 120 years, whenever inflation was below 4%, real equity returns have been strongly positive. I think also from a labor market perspective, yes, the deportations of migrants in the US, that poses a negative supply side shock, which could eventually trigger wage increases and therefore cost push inflation. But I think that's more of a late 2026, early 2027 story. So for now, I think Warsh, when he takes over, if he is approved by the Senate in May, I think is also in a good place to deliver maybe 2 cuts in the second half of 2026.
What do you think of the fourth quarter corporate earnings? Banks are facing increasingly neutral interest rates, and spending forecasts are penalizing tech companies. Do you see more arguments for than against?
No, if I look at my industry models, which we are running, we still see a strong overweight for banks. Earnings revisions are still strong. Yes, maybe we have seen the strongest steepening of the curves, which has been very beneficial for banks' performance. But even if we are going to see a deceleration in that steepening process of the curves, some erosion of profit margins for banks, I think that will be more than offset with volume growth. So credit creation in the US on the back of further bank deregulation, and also in the European area, I think will accelerate given the synchronized cyclical upswing we expect. So I think overall for revenue growth for banks, we're still also in a good place.
By the other hand, what is your stance on fixed income? Generally speaking, are you increasing or decreasing your exposure this year? Do you prefer sovereign or corporate debt?
Yeah, so we are still fairly neutral duration in sovereigns, and I think that the risks are to the upside in terms of a further build-up in term premia, notably in the US. I think that the fiscal situation in the US warrants higher risk premia, and also the risk of a US economy that is perhaps running hot towards 2027, and that could also reinvigorate inflationary pressures, and therefore the bond market might start to demand a higher inflation risk compensation at the longer end of the curve. On credit and risky fixed income, we do see still spreads that are only 20 basis points above historical lows. So I think they are quite expensive. But again, if you still expect decent earnings delivery, we might not see an immediate strong spread widening. Also, if I look at financial conditions, then you could even see spreads grinding lower towards that cyclical low we have observed around 2006 and 2007. Nonetheless, I think there are clear risks on the horizon. Refinancing risk is gradually increasing. And also, given the geopolitical turmoil we have been observing, high yield credit might be the first to respond to any negative supply shock emanating from tariff wars or other sources of geopolitical risk, like an oil price shock.
Finally, Peter, are gold and silver continuing to set the pace this year? What role do you think these types of assets should play in portfolios? Famous 5%?
Yeah, I think 5% is a good number in a world where diversification is getting harder to get. So if you look for instance, at the inflation environment, whenever inflation is above 3%, typically the bond equity correlation is positive. So there is no diversification of bonds relative to your equity risk that you are taking in a standard 60-40 portfolio. So in that kind of environment, you need an alternative asset to diversify your equity risk. And I think to some extent, gold might be that alternative asset. So there is a place for gold in the portfolio, also on the back of further diversification away from US Treasuries, which we might see in the medium term.
Peter van der Vele, economist and strategy at Robeco. Thank you for coming to Análisis TV.
Thank you for having me.